Welcome, ladies and gentlemen, to Commodity TV and a new episode of our online interview series. Of course, we want to get an insight, really from an insider, into the uranium market, and we want to talk to Bram Vanderelst. He is director, part owner, and also uranium trader of Curzon Resources. Welcome and good morning to the Netherlands. I think you are based, right?
I'm based in Belgium, so don't ever call a Belgian a Dutch person. But other than that, happy to be on the show. Thank you very much for having me, Jochen.
Yeah, thanks for taking the time. It has been, I think, 2 or 3 years that we did the first interview together. It's always interesting to speak with a real market participant, because we obviously only see here the spot market normally in the media. The contract market we don't see. First of all, what really everybody wants to know, why is the spot market so weak? We fell the last 12, 14 months from a top at $107, $108 per pound, now to around $64, $63 per pound. And everybody tells us, including myself, we need more and more and more uranium. We are constructing nuclear powers. There are the SMRs. We need it. But the price is falling. Why? Can you give us an idea?
It's a very good question. I get that question 100 times a day. So I feel like I've answered it enough to have a standard answer these days. But maybe before I really go into answering that question, I think it's very interesting that you highlighted that we spoke 2 or 3 years ago, because I almost want to go back to that period of time to answer your question. Mm-hmm. So when we last spoke, I think the market was trading around 55 or below 60 at least. And we really have to look back at that period of time to understand what's happening right now. Because basically what happened after we last spoke, the market rallied tremendously. The market rallied from that 55 level that we were at 2 years ago into the 107, the 108 that you mentioned earlier. And what really happened is the market rallied a bit too quickly, and it got too much steam, and it kind of ran ahead of itself. And I'm talking about the spot market specifically, less so on the term market, more the spot market. And that was obviously a function of what we saw in the media, all of the positive news around nuclear. We saw the restarts of previously shut down reactors. We saw the lifetime extensions. We saw new nuclear being built. We saw SMRs, the AI. So all of those stories gathered a lot of interest. It's a fairly small commodity in general. It's only $10-20 billion worth on an annual basis. And so it doesn't take all that much investor demand to drive prices up. And that's exactly what we saw in the back end of 2023, going into early 2024, is just a lot of money going into a smaller commodity and then kind of creating that snowball effect. And, the physical traders were all very bullish. The utilities were a bit worried. The producers didn't want to sell because they were holding up for higher prices. And the investors were a non-stop source of demand. And so once we got to that 107, 108, and that could have easily been 120, 130, or could have been 90, it kind of topped out, and people started selling, taking some profit on their positions. And at that point, it became very clear that the market had run ahead of itself. The market tipped into what we call backwardation. So the spot price was way higher than the long-term prices. The normal structure for a uranium market is a contango market. It's a fungible commodity that can be stored for however long you want. So there's no reason. The tendency for this market is to be in contango. There's no real reason for the market to be in backwardation unless there's a real short-term need or short-term demand that outstrips the supply. And that's kind of what we saw in early 2024. But then what we've seen since then, so essentially from February, is the market kind of rebalancing to its normal behavior, to its normal contango market. The long-term market, the long-term prices have been creeping up steadily over time, and have done so in 2023, have done so in 2024, all the way through to the bearish market in the spot market. We saw prices on the long-term basis creeping up from that sort of 60 level to 80, where it is about right now. And we essentially saw the spot price coming down to under the long-term price to get back into that contango market. You have the natural structure of a carry trade, which is back into play, which supports the spot market. I think we might have discussed it last time, but as you know, but maybe your listeners don't all know, uranium is a very long-term market. It's different than the gold market or the oil market or the gas market, where it's a lot more about supply demand on a short-term basis. uranium is all about long-term demand. Most utilities cover on a forward basis. So most utilities look at how much uranium they need or how much nuclear fuel actually they need in the future. Then they work their way backwards to how much uranium they need. And they know I need to at least contract 2 years in advance because that uranium needs to go through the value cycle. And I also can never run out of uranium. So I want to have some stockpiles that I can, that I build up and can potentially draw down on if I need to. That gives me a bit of a buffer. And so really what I'm contracting for is always like 3 to 5 to 10 years out. That's really what I'm contracting for. And because I've already got everything for the next 1, 2, 3 years, I kind of have. And I can add to that. I can build my stockpiles, but I don't have to have it. I've got it in place already. And so because of that, where the long-term market is really like what drives the underlying market, and the spot market kind of fluctuates around it. And the spot market obviously is an important driver for the market. It is, as you pointed out, what everybody looks at, especially in the investment sphere. But it's not. It's got a different fundamental setup than the long-term market. The long-term market is much more in tune with what everybody looks at, which is a fundamental S&D, fundamental supply demand. Everybody knows the supply isn't there to fully capture the demand. So we're undersupplied. We're drawing down inventories at large in the industry. We're gonna need more supply in the future. We see demand increase by a CAGR of around 2-3% annualized, and we are seeing supply not really keeping up, and we're seeing supply being heavily constrained, or I should not say constrained, but heavily exposed to big projects that need to come online in the late 2020s, early 2030s. So that's the fundamental S&D on a long-term basis, and that's really where the long-term prices are heading. If you then look at the supply and demand on a short-term basis, on a spot basis, which is kind of what dictates spot prices, this can be very different, because when utilities are already covered in the market and they don't need to buy anything right now, even though they're consuming that material, they're essentially consuming from inventory from previously signed contracts, and some certain supply sources might still come in the market. So you might have short periods of time where you have an oversupply in the spot market from the likes of Uzbekistan and other suppliers who send material into the market, and a discretionary buyers cohort that doesn't really want to or need to buy at that period in time. And so that's what we saw when the market kind of topped out at 107. We saw more supply coming into that spot market, a bit from primary suppliers, but also from investors and traders who had been bidding all the way up and now wanted to take profit. And there wasn't at that point any real fundamental demand anymore. The investors wouldn't want to buy anymore. The utilities were kind of on the sideline. They said, "Look, I don't want to play in this market. It's overheated. It's too expensive. I'm going to wait until the market price comes down, and then I'm going to step back into it." And so that kind of created that negative spiral. And uranium is a very sentiment-driven market as well. When prices go down, people tend to readjust their expectations for even lower prices, and the same trend that you had on the way up, where when the market is being bid up, nobody wants to sell into it. When the market is being priced down, nobody wants to buy into it because nobody wants to catch a falling knife. And that's really what we've been seeing since the top all the way through kind of where we are right now, only to right now find almost fundamental value, fundamental bottom.
Yeah.
We're back in a carry trade. We're back in a fundamental market where it doesn't make sense for new mines to come online at these levels. So I will almost say we kind of had the initial peak. We come back down to more fundamental market dynamics, and we're now set up for the next rally. That's how I would describe where we are at the moment.
Exactly. That would be my next question. When is the falling knife touching the ground? Do you think we are already at the low? And the next rally, to my understanding, is I would say, by summer, probably there could be a swing in the market. This is a little bit my feeling, how I see it. And also, I think 2026, 2027, there might be a much higher uranium price, to my understanding, because when I look at the term, how can I say that? I saw a very interesting graph where you saw the last, I think it was 7 or 8 years, the replacement rate via the contract was not there. That means we lived out of stock, out of stockpile, and you cannot do that forever, to my understanding, because you just said it. You normally have 2, 3, maybe 4 years on your stockpile. But if you deplete that over time, then all of a sudden you are getting in trouble. How do you see that situation?
Very, very interesting points you make and very valid. So I think first answering your first question, has a falling knife caught the ground? It's always difficult to say exactly, but we're definitely very close to a bottom, if not already there. The reason is what I pointed out earlier is because on one hand, the carry trade is back into play, meaning just very quickly for people who don't know what the carry trade is, you're filling future demand by buying spot material and holding on balance sheet to deliver into a future contract. That only makes sense if your spot market is lower than your long-term prices, and if the cost of carry, i.e. the cost of holding that material on balance sheet, both in storage and on financing, if that cost is lower than the long-term pricing. And so that's where we are at the moment. We're looking at around $64 per pound spot pricing. We're looking at around $80 base escalated long-term prices. So especially in the next 2, 3, 4 years, the carry trade is more beneficial than buying long-term prices at the long-term price base indicator. And that provides a floor to the market, because essentially you'll see people buying in the spot market to carry further forward. That's one element. The second element of that is that also the mining industry needs, or the uranium mining industry needs new mines to come online. New mines require incentive pricing that are, covering cost, that are covering margins, and that are covering sufficient long-term coverage to have life of mine contract prices which are below the all-in sustaining cost and a margin. And it also needs to.
What do you think that price would be?
It depends on where you look and what you take into account. But I think 80, 90 is a bare minimum, because what we're looking at right now is greenfield mostly. We've kind of had from 2020 to 2025, we've seen brownfield project restart. Everything that was being put on care and maintenance, or everything that was temporary and suspended, is being restarted, or most of it. There's some smaller projects especially in the US, that are still on care and maintenance, are still not being restarted. There's projects in Africa, a couple, but not very, very many. So the next stage is bringing greenfield projects online. Greenfield projects are a different beast, not only technically and everything else, but also from a financing perspective. The capex is just tremendously higher. You're like, even a smaller mine, you need $150 to $200 million to bring that mine online, because you need the processing plant to be built at the mine site to get the ore into acceptable standard yellow cake. So just the repayment of that capex, plus the ongoing cost has been higher through inflation and through the use of sulfuric acid, higher energy prices, has really created a higher cost. And then mines don't come on, like, even if a mine produces an all-in sustaining cost at $40, mines don't come online when they have a contract price at $40. They need a margin as well. And a mine is typically a beast that lives for 15, 20 years. You want to build a bit of buffer in it, because if the market price were to collapse, you don't want to sign a contract at $50 or $60, because you need longer term coverage. You don't want to shut down your mine in 10 years. So I'm thinking, mines are at least $80, $90. You look at what Kazatomprom published earlier in the week, I think it was last week, with their financials. Their all-in sustaining cost is $30. That's the best operator in the world, and that's an all-in sustaining cost of $30. If you then look at anywhere else in the world, these all-in sustaining costs are 40, 50, and the smaller mines in Africa and smaller resource bases in Australia, you're looking $60, $70, $80 and beyond. And so it's hard to really say what is that marginal cost, because it depends on what mine comes online. Certain mines will come online regardless of cost, because they're state-owned and there's other incentives, especially Chinese-owned mines and that kind of stuff. But long-term prices, need to be well into the 80s, if not 90s and to 100, to really give that runway in prices. And then that's only one part of the puzzle. The other part of the puzzle is, even certain mines that can live with lower cost, talking about, for example, NextGen, the massive mine in Canada, they've got, licensing time frames that are extended. They've got technical build-out phases that are uncertain. Exactly as you said, all of the cash, $2 billion capex isn't an easy easy one to find together or to get together. So that's why, you know, a spot market at $60, $65 is, in my opinion, fundamental value, and probably needs to be quite a bit higher. So actually what we need to see almost is, you know, the long-term price trending higher, because that's where, you know, the long-term contracts need to be signed, and then the kind of spot market following trend, partly through the carry trade, partly just by the fundamentals. And then we haven't seen the investors in the sector for a long time. Most investors have actually capitulated in the last year. So a lot of uranium that was kind of built up in the 2023 is now being washed out into the market again. Do the investors come back into the sector, and do they find value again? So that's why I think the fundamental value, or the price levels in the spot market that we see right now, are presenting fundamental value. Having said that, and I'm always careful to cover both sides, the sentiment in the market is still relatively negative. There's still a view, especially amongst utilities and amongst, you know, the fundamental buyers, that we can go potentially slightly lower, and, you know, there is still, you know, off-take pricing and stuff that can come into the market relatively aggressively, and therefore, is it impossible that we see prices in the low 60s, maybe even high 50s? I wouldn't vouch for it. It is possible. It depends a lot on how material is priced into the market. Uranium tend to have or be in a situation where, you know, pounds coming into the market are slightly more aggressive, pounds being drawn from the market a bit more discretionary and a bit more quiet. Therefore, the price impact for pounds coming into the market or supply is higher than the pounds from the demand side, and especially in a negative sentiment cycle.
Okay, what does it need, to your experience, that this price turns up to the $100, for example, in the spot price? Because my feeling is the volume is so low now that it's even probably below 10% of the whole market. Yeah, because when I talk to companies which are also involved in the physical market, I always hear, yeah, you can maybe buy 50, 100,000 pounds, but never ever a million.
Yeah? That's right. It's very true. What the market needs to see higher prices is a shift in sentiment, and is a shift in fundamental buying volume. So the sentiment thing is what I've described earlier. It's just a negative view amongst most active market participants. It's traders like ourselves, traders like other traders. It's investors who are physically trading, and investors who are trading the spot market through the lookalikes like Sprott, Yellowcake, the AMC, the ETC. And so that sentiment change needs to shift. And what we typically actually see is that it will shift when the market's already bottomed out, and you see the kind of the first $5 to $10 increase, and then people start jumping on the bandwagon. I can say that I'm having a lot more conversations with investors these days than I had throughout the whole of 2024. And that is because what I'm seeing right now is people who've done the work, or investing groups, and especially larger investment groups who've done the work, who've looked into the sector, kind of decided, you know, the price was a bit too high or wasn't the right entry point. And now they're really restarting their analysis, and they're going, actually think this might be close or near a bottom. Let's really look at uranium again and look at what we can do. Obviously, there is a larger thing at play where the Magnificent Seven and the Nvidia and the AI kind of trade has fizzled out a bit. So throughout 2024, a lot of money kind of shifted from commodities into that trade, in the tech trade. That tech trade is less profitable this year, so commodities become back in favor, and obviously uranium is part of that. So there's a larger larger investment thesis that will drive uranium prices higher, but fundamental on uranium, what we need to see is really a bottoming out. How do we create a bottoming out? Is the moment where utilities, the fundamental buyers, step into the sector and say, we think this is value. We think this is the right time to cover. We're starting to see that, again, two ways. One is the carry trade, which is purely price driven, and we see that. And the second is long-term contracting. And it goes to your point that you raised earlier. At some point, the long-term contracting needs to increase, because you can't live off long-term contracting below replacement rate. Mm-hmm. If you're contracting below replacement rate, it means that your contractual coverage in the future is narrowing. Yeah. And at some point, you need to build on the contracting. Second, and you mentioned that as well, is we've also been living off inventories. We've been undersupplied for quite a few years already, which by definition means that you're drawing down your inventories. Uranium or the uranium sector has a benefit that inventories are relatively large because the pipeline is larger. It's not because it's been building up over time. It's actually just a fundamental feature of the uranium space that it's got large inventories because you've got the longer time frame. What we're seeing, however, is that inventories have been drawn down across the board, both at the utility level, but also at the converter, at the enricher level, at the mining level. Again, if I look at the Kazatomprom release from last week, their inventory levels is the lowest for the last 10 or 15 years compared to production.
It's not getting better.
Yeah, so the inventories are being drawn down everywhere. There has been a period of time where the market between market participants was heavily supported through loans. So if you were a producer and you were short material, you're going to people that had access material. You were lending them material to give it back in the future. We're now entering a time frame where like some of these loans need to be repaid back based on new production, but that new production hasn't like fully caught up yet. So there's a lot of dominoes that are starting to fall, and whether that's going to happen in 2025, 26, or 27 is a question mark. But we're living on borrowed time. That's clear. We're definitely living on borrowed time, and it's a matter of time before both the long-term prices then driving up spot prices, or spot prices taking long-term prices with it, are going to be drivers for this market.
So you would say shortly that we can be cautiously optimistic?
I wouldn't even say cautious. We can definitely be optimistic. If I would suggest to anybody who is looking at this trade as a 3-month trade, don't enter it. It's not a kind of trade where you look at 3 months. It's a trade where you look at the fundamental S&D. The fundamental S&D is short, but that fundamental S&D can be played out over 2, 3, 4 years. If I go back to my example about NextGen, for example, NextGen is such an important marker in our industry. It's 28 million pounds per annum production in a market that's currently producing 150 million pounds. So it's literally 20% of the full production stack. They have publicly said they're going to be producing in 2028, potentially early 29. The consensus is going to be more 2030, 2031 at best, if nothing else goes really wrong. But that 2-year delay has a massive impact because you're essentially losing almost 50 million pounds of production in the late 2020s. So where is that going to come from? They're running around the market at the moment with an agent to sign contracts with utilities based on producing or based on production in 2028 and promising the material in 2028. If they don't produce, I'm sure those contracts take that into account, but then somebody is going to need to find that material somewhere else, whether it be the utility or NextGen themselves. And that's just one example. We see juniors all over the place being under-delivering on their production profiles, from the small mines in the US to the larger mines in Canada and in Africa. So across the board, nobody's hitting their production rates, not even the Kazakhs. So I think this market is really heavily exposed to the fundamental S&D. But that can, as I said before, that can take time. It can be, it can take a year before the market realizes, look, actually the pounds that we thought we were going to have, we're actually not going to get, or it will take much longer before we get them. Therefore, we've got a real situation to solve in the late 2020s. And that's also where, the market is interesting, because it's a long-term market and everything is looking forward, but a big shortage in even in the early 2030s can have a massive price impact right now, because also there's a connection between the long term and the short term, and so that price impact can happen early, and it, quite frankly, it should happen earlier, because if it doesn't happen right now, all you do is you're delaying production from new mines, and at some point the market is going to need that material. It already needs it, but it's going to desperately need it.
And I think what we also should not forget is that this market is rising by approximately 2%. I think we are now crossing next year probably the 200 million pound mark in the demand. I don't see 200 million pounds in production, not this year, not in the next 3 or 4 years, never ever. And to be honest, as you were mentioning next gen a lot of times, my feeling is also because 28 million pounds per year, you do not ramp up in 1 year. That needs also time. And I think it's not done in 1 year, it's probably done in 3 or 4 years. So then we are talking for full production already about 2034 or 2035. So that's 9 to 10 years from here. Yes. And we have a structural deficit in the market, which could not be filled even by companies like UEC or ISO Energy restarting, Bots Energy, Encore, Paladin, etc., etc. I don't see that. And I think that the structural deficit, even if I look at it very positive, is still around 35 million pounds at least per annum, probably closer to 40 million. How do you see that? Will that diminish over the time? Because the demand is rising slowly but surely further on. And second question, we have not spoken yet about SMRs, which will come online 2027, 2028, because that's another source of demand, which to my understanding is not yet really calculated because we don't know how many will go online.
Absolutely. So first part of that question, I think you're absolutely right. And that's what I mean with the market being exposed, that in a positive scenario or very positive scenario, the market is going to need all those pounds, like not just next gen, all of the above, like next gen, Camco expansion, Kazakhstan Bram, Uzbekistan, it's going to need almost all of the above, because also once you get into the 2030s, there's a lot of mine depletion, especially in Kazakhstan. The good mines there are starting to deplete quite quickly into the mid-2030s. So that needs to be replaced. You've got the additional demands from the new builds and from all the restarts and the lifetime expansion. So we're going to need that demand. And if I look at what we have on the supply side and we run, like we do in our own S&D, there are enough projects to fill that gap. Let's put it that way. If the price incentives are right, there are sufficient projects to have the 2030s covered with uranium. The problem is that it's a timing issue. We're not seeing the price incentives, first and foremost, and we're not seeing the timelines on the production side work out with the deficits in the late 2020s and the early 2030s. And we talked about next gen, but you can equally talk about what's happening in Niger, what's happening with the Daza project. That's £3 million. What's happening? All these other guys that you mentioned that need to ramp up. What's happening in Kazakhstan with the Budnoskoye project? That's been 2 years delayed and very subject to sufficient sulfuric acid being available. What's happening with the Mongolia project by Orano? Is that finally going to get started? So if you go through the list of projects, there are so many potential projects, there's so many hurdles for all of those potential projects to come online. And it's not a question, if 50% comes online, we're good. No, we need 70, 80% of all of those projects to come online to be good. So if you're a gambling man and you do statistics, you know how difficult that's going to be to get. We're not looking in the middle. We're looking at we already need a lot more to just get to a balanced market. So that's ultimately why the market needs more production. But it's just a question of it's time and money, or time and incentive pricing. If the market stays at an incentive price of $120 long-term prices on uranium, we will see a lot of projects make a lot of progress very quickly. But what we're actually seeing is the opposite right now. We're seeing projects, let's say some of the Namibian projects, that are actually stalling going into production because they don't see the incentive prices on their contracts. They're not going out there and trying to sign contract utilities or with traders or other people because they don't want to have a $70 uranium contract. They don't want to have an $80 uranium contract because it doesn't work for them. Mm-hmm. And especially in Africa, that's very valid. Especially in the US, that's very valid. And those are smaller project, but on aggregate, they're the easier projects to bring online because on aggregate that might be 20 to 30 million pounds, but they're important because if you're purely waiting for next gen Denison and the Kazakhs, we're in some really deep issues here. And
not the same deep shit.
Yeah, exactly. I was being mindful out here.
I see that also.
Okay, so that's definitely the case. Your second question, sorry, with all the rambling, I forgot what your second part of that question was.
Hang on, just I was following so much to your explanations. I'm just thinking about. So that was next gen. No, hang on. With the structural deficit, when do you think that might be diminished?
So I think we'll be looking at the 2030s as a bare minimum. I think we're gonna need to see incentive prices much higher in this year, next year, and early 27, and then we're gonna need to see. We're going to take time. We're going to need to see projects that are kind of on the cusp of development really go to that 24-month process to actually develop.
Yeah, and also I was asking about the SMRs.
SMRs. That was the other one. So with SMRs, I'm less bullish on SMRs. Let's put it that way. I think SMRs will happen. Absolutely. Don't get me wrong. But it won't happen. It won't roll out as quickly as people think. And I think we're going through a difficult setup phase. And that's what we're seeing right now is that for the last 5 years, we went from SMRs were kind of like something on the side that didn't get a lot of attention. I probably need to go back 10 years to, there's now probably 80, 90 different SMR projects. The whole point of SMRs isn't to have 80 different projects. The whole point of SMRs is to have 1 or 2 and build as many as you can in a factory and just, churn them out like you do on a car's conveyor belt.
Which are your favorites? Do you have?
I mean, it's very difficult because a lot of what I think that would be my favorites in terms of technology, I don't think are going to make it because with SMR, and I'm not going to name any names, but I think the problem that we have, on one hand, you've got generation SMRs, your advanced SMRs. In terms of technology, they're the best suited for what the market needs. They can load follow. They've got stored inbuilt storage capabilities. They're inherently safe, even though that generation tree is also safe. But they've got a lot of features that are better. The problem is that they're new technology, and we've seen it on the large scales as well. Every single time you build a first of a kind reactor, it's cost overruns, it's delays, it takes time. The regulators need to get on board. So even though I think some of these SMRs, the high gas temperature, the TRISO fuel, the Nature project by Bill Gates, all of these are the great technology SMRs. I am doubtful that they're going to be the ones that are going to get built. And then on the other hand, you've got the cohort that's no, we got good technology right now in generation 3. We're just going to size that down and build a lot of it. And because of the smaller size and some additional safety features, we're going to be able to just roll them out. Mm-hmm. I think that makes more sense. And so I don't know where we're going to go. I don't know where we're going to go with that. Quite frankly, if it was down to me, I just built a hell of a lot of large-scale reactors. There's, in my opinion, SMRs are only valid in certain applications, like remoteness, like direct access to electricity for mines and very large consumers, or island nations and that kind of stuff. But for most countries, especially where we sit in the Western world, build the large stuff. There's no need to have SMRs. Just build large-scale reactors, because SMRs were initially a reaction to cost overruns and times to build large-scale reactors. But the reason why that happened is because we haven't built sufficient amount of large-scale reactors in the last 30 years. But if you look at France in the 70s, France built their whole nuclear industry in 10 years. From 10 years, it went from almost zero to 70% of their decarbonizing their electricity grid. And that's because
China today, right?
And that's what China is doing today. A Hualong reactor, their domestic reactor, is a 4-year project, 4.5, 5 years maximum.
Nothing.
That's perfect. That's great. And they're financing it internally. They know they've got pretty good financing rates, and they can build it in 4 or 5 years because they've already done it. So if we were to do that in the West as well, with the AP1000 for Westinghouse, we should just be building large-scale reactors. And my question is whether, and this is a general kind of open-ended question, whether we shouldn't be focusing on that in the West rather than try to build SMRs. And because what I'm seeing right now is we're going to build SMRs, but we're going to put 3 or 4 different SMRs on one site. What's the point in putting 300 megawatt SMRs on one side? Well, you can just build a 1 gigawatt reactor. So I'm not as bullish on SMRs as most of other people, but to go along with your question, yes, SMRs will ultimately happen. I think it's going to be more 2030s thing than a 2020s thing, purely because of the regulator playing catch up, and there's a lot of drive behind it, but it does need a lot of money. We've seen SMRs or SMI builders in the US who have scaled down. We see a lot of money being raised for SMRs, but ultimately, at some point you need to generate revenue, and you need deep pockets to build these kind of things. You might have the best technology in the world, but if you don't have the deep pockets and the money raising capabilities, you're not going to be able to build those things. So yeah, I think, and that's also why we don't really see SMRs playing a major role in any big S&Ds. In our S&D, we don't really take into account the SMRs, or hardly any. I'm part of the WNA working groups on SMRs. There is a big push to include them, but what we're seeing is once you get down to the bottom of it, that there is still very little progress on actual SMR, or like actual countries who've committed to SMRs and that we know almost for certain that they're going to get built. So what we do in that working group, or what we do in the WNA report, is we use generic SMRs as a kind of a build-out, rollout, which probably is what's going to happen. And then it's the debate about the time frame. So I think SMRs, and it's a bit the same with AI, are an important part of what might be happening in the future and what's driving nuclear demand, but it's not part of the fundamental thesis why uranium prices are going to go higher, because the fundamental thesis is supported by the current existing fleet of large-scale reactors and the build-out in China, and the lack of supply. The current lack of supply, not the future lack of supply. The current lack of supply and the future lack of supply due to lack of new mines being built. Yes. That's a fundamental thesis. Everything else, SMRs, additional AI demand, that's like the cherry on the cake, if I can call it that.
Absolutely. Yeah, this is how I see it. Also, especially I read this week in a report that China will now build over the next 10 years approximately 100 to 150 large nuclear power plants. I mean, this alone would shoot the demand through the roof. And as we alluded the last 37 minutes, there are no new mines coming that fast online. We don't have the fuel, so it's getting interesting. Okay, short answer before we come to some investment ideas. What is your personal price target for uranium price 2026, 2027 in the spot market? What would you say could be reasonable?
I'd say 120.
Good. Thank you. I have 130. That's fine. We are very close together. That's fantastic. Okay. Then let's talk about some investing ideas. I personally, for example, prefer a Global X uranium miner ETF. I think that's a fantastic product of Global X. Of course, I have also invested into companies which are in production now, like UEC, for example, or URC, ISO Energy is going in production. I really like that too. But I think there's also another way from my friend Patrick Michaels, for example, from Zurich Invest. He has a managed uranium account and an ETC. Can you comment on that, please?
Yeah, absolutely. Just before I step into that, I think there's two ways of investing. One, you can invest in mining projects, which is what you highlighted, and you take on a lot more risk because you've got very specific mining risks. Potentially more upside because if the mine does well, although that's debatable. At certain points in time, the mines have been actually overvalued compared to the physical. And on the separate side, you've got the physical, which is where the real story is. Like the real story is in the physical sector. Obviously, some mines will benefit from it, some will peter out. But so to your point, and the AMC that Zurich Invest is running, and the ETC that's a wrapper essentially has been built around it. That's a new product that's currently been launched on the Frankfurt Stock Exchange. Mm-hmm. Those are physical products. Those give investors like yourself and larger investors access to the physical product without having to go through, opening an account at a converter and go to the legal work and the setup and the compliance and all of that. So that, in that sense, these are tremendous products. So the Zurich Invest AMC has been around for about 2 years, I think, and I think that's when we spoke last time. What we saw, because we're involved in it as well, we supply the material to the AMC as and when it's needed, and we buy the material from the AMC as and when people want to redeem it. Mm-hmm. What we see is that the AMC as a product is working really great, but the access for investors was quite difficult because it's very much a Swiss product. In Switzerland, people are familiar with it. You take it out of Switzerland and it becomes a bit of a headache. So what Patrick and his team have done right now, they've built a wrapper around it called an ETC, or an exchange-traded commodity, which is a listed product on the Frankfurt Stock Exchange. It still trades primary market only because you need to be able to redeem and issue shares to keep your peg with the physical uranium price.
Yeah.
But it's accessible through the pricing accessible through the markets, which means that it can be reported by Bloomberg and Reuters, which means that any hedge fund around the world can buy it. And it's also, and I don't know the technical details, but it's compliant for essentially hedge funds around the world to buy it, whether it be America, US, Canada, UK, Asia, Singapore, which wasn't the case for the AMC. So the access is a lot wider. And I guess the benefit on a physical product is that you're playing the physical market. And so you're not taking in the risk on the mining side. You're taking in the risk on the uranium physical side, which I think is the best risk reward. I would almost say, and I do the same in my portfolio, the biggest chunk of your portfolio should be on the physical side. And then you kind of top it up with specific mines, and you think about it from a potentially hedge or from a bootstrapping your returns. Like if you hedging, for example, I'm going to make it very simple. It's something I've done in the past. Is you buy a physical via one of these vehicles. You buy Kazatomprom, for example. Kazatomprom has got a great, they've got great yields. They're the bellwether of the uranium space. If something were to happen geopolitically, the physical is going to go through the roof because you're taking 40% of the. And if everything stays steady, physical is just going to go up and Curzon is going to go up. Or you could do what you do is you take some of the smaller mining projects, which if and when they do come online and they generate the cash flows, they tend to do really well because they go 2x, 3x, 5x, and a lot of them have already in the last 5 years. However, what we're seeing right now, and this is why I think the story about being in the physical sector is even more important, that a lot of these junior miners have had their initial run, they've done their 5x, and a lot of them are back trading at the level they were like in 2023 and some even in 2021 because they've kind of done the round trip. They've gone like, oh, this is great, this is going to go into production. Or maybe the reality is that they might not go into production, it'll take a lot longer. And and when you run a DCF, this kind of cash flow model on a mine, when they come into production, if they come in production, plays an extremely important role. So that's why I kind of think a well-balanced portfolio is significant portion into the physical, and then a smaller portion into the junior miners, and maybe in the middle, a larger allocation to a Kazatomprom, a Cameco, existing producers who are cash flow rich, and who are also bellwethers for the uranium as a sector. I think that's kind of how I would see it. And if you then look at the physical sector, I think the AMC or the ETC are extremely valuable products. They're tracking the physical sector or the physical uranium price on a one-to-one basis, so they're fully following it. You have other competing products out there, Yellowcake, Sprott, Physical Uranium Trust, which are already in the sector and have done extremely well. So kudos to them. But they are facing issues with trading below net asset value. So the discounted net asset value is blown out or has gotten bigger over time, and the trend is negative in that sense. And so they're typically trading at 10-15% below net asset value. And so if you're going into the physical market through these vehicles, you're exposed to that discount as well. And if that discount blows out, then obviously that's a risk. If I just look at Sprott, for example, Sprott has, I don't know what the market cap at the moment, but it's between 5 and 6 billion. When investors want to get out of that at some point, there's no way out. You can't sell the physical. So, the share price gets sold down, your discount widens, and you might be entering the vehicle at say $64 right now today. Market goes up to 100, but if your discount widens to 30%, you've only captured 5%. Whereas if in a physical product with a direct peg, you get the whole upside.
Yeah, absolutely. Super. That was a great final sentence. Thank you very much, Bram, for your really 45 minutes insight into the uranium market.
Welcome.
I think we discussed everything necessary. And I want to say thank you very much. I like your price target, $120. That's perfect. I think that would help a lot. And I would say, we talk very soon. Again, not only in 2 years, please, because it looks like the uranium market is getting harder and harder. So
exactly.
Thank you very much.
Let's plan something for the back end of the year or early 2026, and then
please let's do that.
You can hold my feet to the fire if it's not $120 yet.
Okay, I like it. Super. That's how we do it. Super. Thank you very much. I wish you all the best. Good luck with all the trades and everything, and also with your newborn child. All the best for that also. And please take care, and we talk very soon.
Sounds good. Thanks a lot, Jochen. Appreciate it.
Thank you very much. Ladies and gentlemen, that was Bram Vanderelst, the part owner and also director of Curzon Resources. He's also a uranium trader. And you saw in the last 45 minutes, I think that was a brilliant insight into the uranium market. It looks like that we are very close to the bottom, to be honest. And I have also a very good feeling that by summer, this restarts here again because capitulation is in the market. A lot of investors have thrown the white towel, I would call it. And to my understanding, this is one of the best investment theses I've seen in my 43 years since I'm at the stock exchange. And fundamentally, this is outstanding. And I really have a good feeling that the $120 by 2026, latest 2027, but I think also 2026, this is makeable on the spot market per pound uranium. I have $130, so we are quite close together here. And make sure that you have also diversified into uranium companies, good producing companies, to make sure to be on the safe side, and also some physical stuff like the products we just discussed here. So thanks for watching us, and bye-bye from Switzerland.